Hey guys, what's up and welcome. In today's video, we have a two-piece. We're going to be hearing from two Fed officials. We have the Atlanta Fed President saying we are not going to see a recession. That is a big call in an economy like this. Then we have the former Fed Vice Chair. He says, and he's going to give us his expectations for rates into the year end. So we've got a big video. Let's see what else we've got. We've got the Qs and the SPYs breaking down, guys. Stocks are following. Amazon's down 2.5% by noon. Tesla's down another 4% by noon, guys. Down over 18% in the last 3 days. That is crazy. It's now trading around $210. Came from around $260 not too long ago. And what's really happening, what's causing the stock market to break down today, guys, we have the 10-year Treasury just crossed 5% for the first time since 2007. So we've got some bad indicators going on out there. As always, I hope you guys enjoy the video. If you do, hit the like button. Thanks for being subscribed, and let's jump into them.
Yes, Raphael Bostic, the Atlanta Fed President, joins us now on a fortuitous day. Raphael, thank you for joining us.
It's good to be here, Steve. Good to see you.
So I would almost never start an interview with a Fed official like this, but because yesterday was so confusing, I need to ask you to help us put what the chairman said into context. If you look at the 10-year, the yield was up, it was down, it was sideways, and ultimately it settled lower. The 2-year yield went up, went down, went sideways, ultimately settled a little bit lower. The stock market was up and down. Was it a hawkish message? Was it a dovish message? How did you put it in? I know you listen to the chairman almost probably more closely than I do.
I listen to him every day, and it's actually very important. Look, these are complicated times because there are lots of things going in all directions. We have inflation's come down a lot, and I think the momentum is going to continue to be that way. But you see the resilience in the broader economy, which makes it difficult, and that it's a complicated thing. And so in talking about the economy, it's always a challenge because you have these cross currents. Whatever narrative you want to tell, there is some data that's a counter on it. For me, I just try to stay focused on looking ahead, trying to get intelligence about where people are thinking and feeling the economy is going to go. And what I've learned in the 6 years I've been in this job is that when you talk to real people and they tell you real things, it's real. And so I really try to lean into that and take that on board.
And what are they telling you now, and how different is that?
They're telling them that groceries are too dang high. They can barely afford gas. They're on their credit card bills. They don't have any savings. I mean, they're not saying good things, I would imagine.
From the strong data that we've had recently, strong retail sales, up your Atlanta Fed GDP is practically a skyscraper out there.
It's north of 5, which is high. I understand that. But look, when I talk to businesses, they all tell me the slowdown is coming. They see it. They are seeing their customers start to act in different ways, and they expect that where we are today is a lot stronger than we will be 6 months from now. I've really taken that on board and thinking about what restrictiveness looks like and how it's likely to play out over the next 6 months.
To me, that doesn't make any sense. If he's asking real people and they're just now starting to say that they're seeing a slowdown, wouldn't this be the beginning, not the end of the slowdown? Maybe shouldn't it only get worse? I don't know. I guess he's choosing to say maybe we've been in it and it should only go up from here, but the Fed lags are just now starting to catch in. So if he's just now starting to see it, it could continue for a while.
I open it up to my esteemed colleagues. I just need to ask you this question. You are the only Fed official, from what I can see, who has used the phrase sufficiently restrictive. Chair Powell yesterday twice got up to there and said, no. He twice said, we're still looking for that level. Are you going to be sat at the table all the way at the other end when you get into the next meeting, or are you feeling alone out on a limb? Do you still feel like the Fed is sufficiently restrictive here?
So you'll have to ask everyone else sort of where they are. My seat is set at the table where it is.
Oh, it doesn't change based on your views.
They don't move us around depending on whether they're happy with our view or not. But what I would say is this. I've listened to a number of my other colleagues, and what they have said is very similar to what I'm hearing, which is the businesses are feeling and they're seeing the slowdown. They're anticipating things will contract and constrict from here. And they say a bunch of our policy tightness still hasn't gone through the whole economy. And so I think the trajectory of the economy is likely to go in a way that is very consistent with what my outlook is, which is we are not going to see a recession. That's not in my outlook. We're going to see a slowdown, and inflation will get down to its 2%.
President Bostic, I hear what...
And it's going to get down to 2%. Man, this guy is more bullish than Tom Lee.
Chairman Powell said yesterday, and I kind of think, okay, it sounds like he's not really eager to raise rates. It sounds like this has probably bought some time for the committee to decide what they want to do next. Is that the sense you get? Like, he doesn't want to let markets know that maybe they're done, because that would do some pretty lousy things anyway if the market takes that and runs to the bank with it. But at this point, look, we're going to look around. We're data dependent. To me, that says we're just going to see what happens.
Well, I think we're always that way. I mean, so we always want to see what happens. I think the risk is that the market gets ahead of itself and starts to anticipate that we have had an outcome before we've actually had the outcome. And so as I talk about it, I really do try to keep people focused on, look, inflation is still at 3.7%. Our target is 2%. They are not the same, and we have to get a lot closer to the 2% before we're going to consider, before I would consider any kind of relaxation of our posture. Inflation is job one. We have to get that under control. And there's a risk that if we start to hint, oh, we think we're already there.
We think rates are coming down.
Exactly. And I don't, that's not in my head today. And I don't think that we'll be cutting rates before the middle of next year at the earliest.
We won't be cutting rates before the middle of next year. He's saying he's expecting a slowdown. He's saying we're not going to get a recession, guys. I just do not see how that is a possibility. And I like to think I'm as long-term bullish as possible. Some could argue we're already in it. Some could call it a rolling recession. You can call whatever you want this last year and a half. It hasn't been pretty. Hasn't been too many gains except for in the Magnificent Seven. And now, the last several months, they're starting to give those back. Last 5 months, Microsoft and Apple and a couple others are basically flat to down over the last 5 months. So we've definitely had some stagnation, but we haven't had a panic drop. Now let's jump into the former Fed Vice Chair. He's going to talk about some rates into the year end or non-rates, his opinion.
Powell's comments, did you come off with the sense that he was hawkish or dovish?
I came off the sense that he was straight down the middle, and here's why I say that. He observed that indeed policy is already restrictive. He observed that they're making progress towards their goals. He observed that, and importantly, they're making progress towards both goals. And he said they had to be prudent or cautious in how they proceed. So I think in terms of the short term, it felt more like a wait and see speech, no movement in November. He had to say, as he did, over the longer term, the economy continues to be strong and they are prepared to move. So I think I wouldn't describe it as hawkish. I think it was straight down the middle with probably not much excitement about moving in November, open to moving if necessary, one more time this year or maybe early next year.
Can we just take a minute and just respect how hard it is to give a speech in front of the world, answer all the questions for people that have questions to get to answer about the economy. And he can answer every question in such a way that all of these officials are literally confused on was he hawkish or bearish. I mean, hawkish or dovish. It's like, that's just pure genius. The AI algorithms don't know if he was hawkish or dovish. The people don't know how to take his message. I mean, if you're Jerome Powell, that's exactly what you want to hear.
So I don't know if that's hawkish or dovish. I think he's trying to take it straight down the middle.
I think a lot of people are trying to figure out if it was hawkish or dovish as well, Roger, in all fairness. I do want to ask you about his comments about bond yields. He basically said, and I'm paraphrasing, I'm not saying exactly what he said, but he says it looks like the rise in bond yields is doing some of the Fed's work for it. He believed that they were rising for what he called the right reasons, not just because people believe the Fed is going to take action. What did you make of those comments?
I think two things. One is, yes, they are not anxious about it. I've heard a number of Fed officials in their public statements saying something very similar, that because the 10-year and bond yields in general are higher, that may be doing some of the work for the Fed. I was surprised that he said it had nothing to do with Fed expectations or expectations of Fed policy. That's almost never the case. But he is right, there are other factors as well, including an expectation that the economy is going to continue to be relatively robust, as we've seen from incoming data. And I think he mentioned appropriately, fiscal policy. The government is having to issue quite a bit in the way of Treasury securities to make up for the spending that's going on.
There's one change in tone from Jay Powell. I know you noted this as well. We had initial jobless claims out yesterday, lowest level since Q1 of earlier this year. And he didn't really highlight that. In previous times we've heard from Jay Powell and other Fed officials, They've really cited tightness in the labor market as inflationary. This time, didn't really talk very much about it. What did you make of that?
I made of it exactly what you said. So one of the reasons I answered your first question is straight down the middle, is things he didn't say that he has historically said. One, he did observe that there is some tightness, but the labor market seems less tight than before. Two, he didn't talk about what's called, sort of super core inflation, which was one of the things that he had been talking about in the past. So I observe, as you did, some of the things that were not said were, to me, pretty telling. And that's why I came to the conclusion that probably not a move in December, but in November, but ready, but not that decided about a move in December.
All right, so to the big question now, Roger, I think a lot of people are probably asking you for advice about this. When do you expect the Fed to actually cut? People are saying, of course, they have to stop hiking before they can cut. But when do you see a cut at least possible? Do you see it in the first half of 2024, the second half of 2024, at all next year?
There's no way. Before he answers, I'm interested to see what he has to say, of course. In my opinion, there's no way we're getting a cut anytime next year in 2024. I realize that is pretty bearish, and that's not gonna go good for the stock market. But this ramp up is insane. To instantly backtrack it would be even more destructive to the economy. We have to stay higher for longer. We've already made the decision to go up this fast.
Next year?
I think my view has been probably not next year, if next year at all, certainly towards the latter end of the year. First half, absolutely not in the cards. Depending on how things play out, that next hike, the last hike, might not be December, it might be the beginning of the year if the economy is proven to be strong enough. So I think it's highly unlikely to see a cut next year. If we do see one at all, it would certainly be the second half, certainly not the first half.
Let me ask you a more longer-term question. Jay Powell, and again, I'm paraphrasing, essentially said, and that's what I took out of it, that we might just be in an environment where we're going to have a higher neutral rate. It'll just be higher from now on. What did you make of that?
I agree with it, frankly. I think many people do not recognize how unusual the last 10 to 15 years have been. It is not meant to be that money is free, relatively speaking. Getting to what's called the zero lower bound, where the Fed set Fed funds target is at or close to zero for long periods of time, is abnormal.
I know that's shocking as a small business owner to hear, to say that free money is not the normal. Well, any business that started within the last 10, 15 years is built on free money. So that's why so many businesses are going bottom up. That's why so many people are going bankrupt. That's why this economy, everybody's leveraged for 0% interest or very, very low interest. For it to skyrocket like this catches a lot of people off guard, and money can't normally move fast enough to get people right on the right side. So it's definitely a big shakeout in the economy.
Not the normal thing. So I would think that the possibility of rates being, frankly, back to normal, higher than they have been historically for the last 10 to 15 years, but similar to what they had been earlier, is very much in the cards. There are a lot of forces that suggest that might be the case. So I'm in alignment with the thought that we should not get used to money being free. That was abnormal, and we should expect more normal pricing for money all along the yield curve.
We should not be getting used to free money. I think that's already been the trend for the last year or two. Everybody that was used to free money has been absolutely obliterated. I hope you guys enjoyed the video. We checked out some of the former Fed guys. They should have the best intel on what Jay Powell's going to end up doing here. Even they don't know. As always, guys, I hope you enjoyed the video. If you did, hit the like button, and I'll see you tomorrow. Peace.